When a high-stakes legal case finally settles, you might think the battle is over. Well, think again. In many ways, the most dangerous part is just getting started, the financial execution. Get this wrong, and a hard-won victory can completely fall apart. Today, we are conducting a forensic audit, a deep dive for legal and financial pros on how to navigate the incredibly complex tax rules around settlements. Welcome to the Structure Audit.
Our audit kicks off with just one number, but it's a number that should get your attention: 30%. Yeah, this is how much of a settlement's total value can just vanish, gone, wiped out by hidden tax traps, regulatory landmines, and simple, avoidable errors. It's a huge, preventable loss, and our mission today is to give you the protocol to stop it from happening.
So here's our game plan. We're going to move through 6 key checkpoints, step by step, all the way from that initial settlement decision to the final IRS paperwork. Now think of this less like a checklist and more like a protocol designed to protect the full value of your client's recovery and build a rock-solid defense if the IRS ever comes knocking.
Okay, let's get into it. A settlement isn't just the end of a legal battle, it's the beginning of a whole new financial reality for your client. But it's precisely at this moment where that legal win turns into an actual asset that things can go sideways fast. One wrong move here can trigger massive, unexpected taxes, turning a huge win into a long-term financial headache.
The very first checkpoint in our audit is getting your head around this fundamental divide. It all comes down to Internal Revenue Code Section 104A2. And here's the rule: damages you get from personal, physical injuries, or physical sickness, generally tax-exempt. Pretty much everything else, we're talking emotional distress on its own, punitive damages, interest, that's generally taxable. This one distinction drives every single strategic decision from here on out.
All right, now we come to it, the single biggest threat to a tax-advantaged settlement. This is the one you have to watch out for, the Constructive Receipt Doctrine. It's a regulatory landmine that can blow up your whole plan before a single dollar has even been paid. So naturally, it's a huge focus for our audit.
The key word to focus on here is control. The IRS says you've received income the moment you have an unfettered right to it. It doesn't matter if you've actually cashed the check or not. If the money is subject to your unfettered command, as the Supreme Court put it, it's taxable, whether you see fit to enjoy it or not. You can't just turn your back on it to put off paying the taxes.
And this right here, this is maybe the most critical checkpoint in the entire audit. Timing is literally everything. If a settlement release gets signed that creates an immediate, unconditional obligation for the defendant to pay cash, you're too late. The trap has been sprung. Constructive receipt has happened. And any attempt to set up a structure after that point, the IRS will just see it as you taking the cash and buying your own annuity, which means all the future growth is going to be fully taxable.
And hey, don't just take my word for it. The legal precedent on this is crystal clear. The big case here, Childs v. Commissioner, really settled it. It confirmed that as long as the agreement to make payments over time, the structure, is a binding part of the deal before the money is unconditionally available, you avoid constructive receipt. Our audit has to verify that this exact sequence of events was followed, no exceptions.
So we've identified the main tax hazard. Now our audit moves to the central economic choice that every single claimant faces. Do I take the lump sum, or do I go with a structured settlement? And this isn't about gut feelings or personal preference. This is a hard-nosed analysis of liquidity, risk, and, most importantly, tax efficiency.
Now, at a high level, the choice looks simple, right? It's immediate access to cash on one side versus long-term security on the other. But the real powerful difference, the one our audit needs to zoom in on, is buried in the tax treatment of these two options.
Okay, I want you to focus your eyes on that top row, tax treatment, because this is the heart of the audit right here. With a lump sum, sure, the principal amount is tax-free, but the second you invest it, all the earnings, the interest, the dividends, the capital gains, it's all taxable. But with the properly executed structured settlement for a physical injury case, IRC Section 104A2 makes not only the principal tax-free, but the entire growth component as well. That creates a tax-free income stream that is incredibly hard to replicate in the public markets.
So how is this incredibly powerful tax benefit actually achieved? I mean, what's the legal mechanism? Well, this next phase of our audit is all about following the paper trail. We're going to examine the specific mechanics you have to follow to do this right, a process that's known as a qualified assignment. This four-step process, which is all spelled out under IRC Section 130, is the whole key. First, the two sides agree on periodic payments. Second, the defendant assigns their obligation to pay to a special third-party company. Third, the defendant funds that assignment by paying a single lump sum to that company. And finally, and this is a big deal for the defendant, they get a full release from all future liability. The assignment company then takes the money, buys an annuity, and takes over the job of making those guaranteed tax-free payments to the plaintiff.
And it is absolutely crucial that our audit makes this distinction. For settlements that are taxable, let's say an employment dispute, you can still use a structure. It's just called a non-qualified assignment. In this case, the benefit isn't getting out of taxes completely, it's tax deferral. So instead of getting a giant taxable lump sum in a single year that pushes you into the highest possible tax bracket, the income gets spread out over many years, which can seriously lower your overall tax bill.
All right, let's talk paperwork. No audit is ever complete until we check the reporting. And believe me, in the world of settlements, getting the wrong IRS Form 1099 is a huge red flag. It can trigger an immediate and often aggressive inquiry from the IRS. This is a super common point of confusion, and our audit has to make sure it's handled perfectly. So, which form is the right one to use?
First up is the Form 1099 MISC. You'll see this used for reporting other income, which in our world usually means taxable damages, things like emotional distress that isn't connected to a physical injury.
Next, you've got the Form 1099 NEC. This one is very specific. It's used to report payments made directly to the attorneys for their fees, and it classifies that money as non-employee compensation.
And finally, we have Form 1099-R. Now, pay attention here, because this is a critical distinction. While the 1099 MISC is pretty common for taxable settlements, if a non-qualified assignment company is making payments out of an annuity contract, they might issue a 1099-R. This reports the income as a distribution, which goes on a completely different line of the 1040 tax form, a detail that every tax preparer needs to know.
And here it is, the single most important takeaway from this whole section. For a fully tax-free physical injury settlement, the plaintiff should receive no 1099. Period. End of story. If a company issues one by mistake, it's going to trigger an automated notice from the IRS demanding to know why that income wasn't reported, and that forces the taxpayer to fight a battle they never should have been in. This brings us to our final phase. We're going to take everything we've just covered and synthesize it into a clear, actionable defensive strategy. We'll pinpoint the common mistakes that gets you on the IRS's radar and then outline the exact documentation you need to defend the settlement's tax treatment.
These are the tripwires. An inconsistent 1099, like we just discussed, is an automatic flag. If the settlement agreement is vague and doesn't say what the money is for, the IRS will happily decide for you, and you probably won't like their answer. And this last one is a killer. If the plaintiff is ever named as the owner of that annuity, they've received a taxable economic benefit, and the entire tax-free nature of the structure is destroyed.
And this is your armor. This is the essential defensive file that every single practitioner needs to build and keep. The original complaint shows the origin of the claim. The medical records are your non-negotiable proof for that physical injury exclusion under IRC 104A2. The negotiation emails and final agreements document the entire process, proving you followed all the rules we've audited today.
So, our audit really just boils down to this one question. Because after all the work of a legal victory, a failure to conduct this kind of rigorous structure audit can undo everything. The final line of defense isn't fought in a courtroom. It's built with meticulous financial and tax architecture. So the choice is simple. Is the recovery built to last, or is it built to be taxed?